Well, hello and welcome to all of you to our Boom Doom Zoom program. This is our third week, isn't it, Paul? Paul Rickard, of course, is joining me.
Thank you, Peter. Yes, I think it is our third week.
And gee, the market's been nice to us as well, hasn't it, Paul?
Well, if you wrote, I use your joke here, Peter, an article I wrote this morning, the biggest bull market of all time. It's not too far off. In fact, I was reading something on CNBC this morning that said that the recovery in the last 45 days is the biggest increase in the US market over any period of 45 days.
Mm. And was the fall of the market the biggest fall ever in any one day?
I'm not sure I can answer that. I don't know if that goes back to... was a biggie. Yeah, I don't think I can answer that, but certainly over the period it was. So we had almost the biggest move down over a concerted period and the biggest rise. So the bull market, where are you reading that at the moment?
That's true. It's certainly extraordinary. And the bottom line is, if the market falls by 20 in a bear market, if it gets out of that 20% drop, you're back into a bull market. It's the technical description of what we do on the stock market. Well, we're here. You know, I should throw a couple of things in. We have a disclaimer. Basically, we're sharing our best views. It's really financial education. It's not advice because we don't know your circumstances. If you do want to move on anything you hear today, try and seek advice from someone who is qualified to help you. There's a hands up function on your Zoom screen. If you want to ask a question, just click hands up, your name will come up and we'll see you're ready to ask a question. Unmute yourself on the Zoom screen. My good colleague John Bragg says it's very self-evident. If it's not, send you a nasty text. It should come up as a pop-up, shouldn't it, John? Yep, he's nodding agreeingly here. If you want to text in a question, just go to the Q&A function. Once again, he says that's pretty self-evident, and I, for one, believe him. It will be found at the bottom of your screen. So without any further ado, we do have a few questions already coming in via text. Also, we have some names there, but there's no hands there, John, so I don't call it yet. First one comes from Robert Millevoix. That looks very French to me. With the talk of rotation into value stocks, is there an ETF that operates in that space? Good question, Paul, isn't it?
Look, it is a good question, Robert. I'm going to stand, I don't think there is, but I'm happy to stand corrected if someone else tells me the ETF. I can't think of one. I mean, you could argue there's a financials ETF. You could argue, well, that's sort of value. We've already seen the rotation to that. I think earlier this week, we had value stocks. We had an article from James Dunn on Monday, pointed to 4 value stocks. I can't think of the ETF, Pete. So,
no, if I was you, the one company that has a big range of these sorts of things, beta shares. If someone's going to have it, I reckon beta shares would have one. And they would probably call it VAL or something like that. They usually go for the most obvious name known to mankind. Okay, let's go to the next one. Peter Wong. Good day, Peter and Paul. Thanks for having me call. CGF reaffirmed FY20 net profits guidance of 500 to 550 mil end of April, but the stock price did not rebound. On the contrary, it fell from $5.37 to $4.86. Being Australia's largest annuity provider, and with the industry experience good tailwinds, I think there is something not right. What do you think about CGF? It's been a company that always defies logic, doesn't it?
Yeah, it's a really hard company to get a handle on. I've made the mistake of being long on it a couple of times and not been and lost money. And it's sort of, I think there are a couple of things. One is that with lower interest rates and lower bond rates, that's not necessarily great for a CGF because of its investment portfolio. Two is it's always believed by the analysts to be not enough capital, and they always go out of their way to say there is. And then thirdly, it's doing a lot up in Japan, and there's some not question marks about that. I think it's just currently one of these unloved stocks at the moment. The analysts have been burnt. You can see it by that chart, just what's happened.
Yeah.
A lot of people got burnt on Challenger, and I think they've been very reluctant to sort of put their hand back into it. And I think that's why it ain't doing much. And I think it's a bit like the AMP. It's just out of fashion, and I don't think that's going to change quickly.
Yeah, and the analysts have a 11% downside, Peter. And look, the irony is, Paul, that probably at these prices, because you can see from the chart, it's had a big drop. And looking at the uptick from the bottom, it looks as though you could gamble that it's going to head in the right direction. But I think the problem is low interest rates and what annuities are offering. It takes a very special person to want to buy into annuities at these interest rates. I've been praying for the time where I get an annuity at 5 or 7%, Paul. And I'd go in for it, but they're a long way off. But I think a chartist would say there's some promising sign. It's hit a bottom and it started to creep up. But it's not one of my stocks, Pete. David, no, we got one from Shabir. Hands up. Hello, Shabir. Okay, we need to talk.
Hello.
Are you hearing it? Are you hearing it, John? And I'm not.
Hello.
Hello,
we can hear you.
Shabir.
Yep.
Gotcha. Question.
Hey, and Paul, thanks for the time. I just wanted to get your views on QBE for a long term, maybe a 1 to 2 year kind of a view. Would you buy at this current levels?
Look, I'm probably in the QBE camp at the moment.
Yeah.
I have been there for a little while. I think it has done its penance for all its acquisitions. Look, it's struggling to recover. One of the reasons it's struggling to recover again, it's in that insurance category where it has a big investment portfolio and interest rates are so low. There's no investment return. And so that's one of the reasons why it really hasn't seen much of a rebound. It also did a capital raise not so long ago. I was probably causing a bit of indigestion. I don't think it's a stock that's going to go up and, if the market goes up another 10%, I don't think it's going to go up that at the moment. But I think for a couple of years, it's probably not a bad, I'd be more inclined to mark that down as one to have in a portfolio.
Yeah. Analysts got about 18% upside, Shabir. It's been a disappointing stock, and looking at the chart, Paul, there's no real kick up at this point in time. It's sort of the bottom has been sort of set in. But the only positive I can give you is that the analysts believe there's 18% upside.
I think for a couple of year play, it's not a bad one.
Yeah, okay. All right, so I've got a text question here from David Robinson. What is your view on TLS currently? Some are saying value at $4.
Yeah, the analysts, look, I think TLS, if you want a
people.
fairly defensive stock, I think Telstra is okay. And I think, it hasn't done a lot. It hasn't been battered down. It did better than others during the market down. It's been slow to recover. Hasn't got back down through $3. It's sort of largely on track with guidance. I mean, obviously, one of the things Telstra has done is it's provided subsidies and abatements, to its small business customers.
Yeah.
And that's question mark about how long they last for. But if you think the recovery is going, that's going to be a positive for Telstra. I think, it's probably that dividend of 16 cents is probably still reasonably secure this year. There's still some question marks around the NBN component. There's two parts to that dividend. There's the ordinary dividend. There's also the special coming out of the NBN proceeds. Look, I think at $3, I thought Telstra was looking right around $3. It's sort of about $3.25. I think it might be starting to form the base of where people are going to come back into Telstra.
Yeah, analysts think about 16.7% upside. I think also it's a fair call to say, Paul, that Telstra would have lost a bit of business from, imagine all those salespeople who are out there on the road doing their stuff. So there would be some demand side or revenue going down. But once we start getting back working again, I think people working from home is not going to affect Telstra's bottom line. In fact, it may well increase the amount of usage. So I can believe, and by the way, Julia Lee, the other day on our Monday investing show, she mentioned Telstra, and she's been pretty good at calling Telstra in the past. So, yep, I think it's a worthwhile one.
I certainly wouldn't be selling at these levels. And if I had to hang on to one stock, I think it looks pretty safe on the downside, I think, is Telstra. So if it's safe on the downside, that gives you more confidence to hang on.
Yep. John Daly's question, Paul, do you ever short the market?
Look, I don't.
Companies.
No, because it's too hard as an individual. If you can short the market if you can borrow the stock, there's a whole lot of requirements. So I'm just too small to be a short player. If you want to take a bearish view in the market, there are things like the bear ETF. There's a couple of ETFs.
Some beta shares.
Beta shares. But it's too hard it's too hard for an individual to do it.
Yeah, I got to say, John, I don't do that either. You reading me over the years, you know, my general strategy is to buy the dips, and of course, this latest dip has been a good reason for me to buy a fair bit. But I often go quiet when the market gets to the top because it's hard to find the kind of companies I want to buy. But yeah, the bear one is a good one to have a think about, and I think Michael McCarthy got the solve pretty well right by taking a.
I mean, if you can buy put options and stocks. I mean, look, that's the options waste. You pay big premiums, so that's the other way to do it. But I mean, I think you'll find most of the professional shorters have pretty big war chests. They've got lots of capital. They're not doing it half-hearted, and they're very patient, and they're prepared to. Often they'll take a short position, they'll be long against something else. So they're not necessarily taking market exposure. They'll say that, you know, we look at retail stocks and we think that, you know, JB Hi-Fi is going to outperform Harvey Norman, so they'll be long JB Hi-Fi, short Harvey Norman. That's the type of thing they're doing. So they're not taking much market risk. They're just taking, you know, they tend to back their view about particular companies. Not big enough for that.
Yeah.
Wish I was.
Well, it's a tough game, you know, because the markets rise over a 10-year period. The market will probably go up 8 years out of 10. The other two, you have to be get the timing right. If you do, it can be a nice way of making money. There's a question from Russ. I think we got this last week as well, not necessarily from Russ, on My State Bank. Did they presented?
They must have done something. That's the Tasmanian bank that used to be.
I think Queensland Bank bought the Tasmanian one as well. They added it to
My State. Look, I'm sorry, I'm not a fan per se. I don't understand.
Yeah, like little banks bought.
Well, I don't see they've got much to add in this environment. I'm not being bearish on them, but I don't. What's the question?
Well, yeah, what's your view on My State Bank?
Look, I prefer one of the majors. So I don't know enough about how you rate My State versus Bank of Queensland.
And the analysts don't cover it as well. Yeah.
So we're not negative on it. If all banks go up, it'll follow. But it's a
it's a good little honest achiever. I just don't see it shooting the lights out, Paul. All right. Jacob's got a question here on Vicinity. Is raising capital SPP offer. Is it a buy?
Well, look, I mean, I think it surprised the market a little bit. I mean, obviously, retail shopping centres are doing it really tough. Vicinity's got some of the better ones. I think John Gandal's stepping up to put $100 million in as well. I can't recall offhand the price of the SPP, but I think it is well below that. So I'm a little more circumspect long-term on these shopping centres. They're going to have to really transform into entertainment and other precincts. I mean, Vicinity's got some.
I think it will, but they've got to do it.
Vicinity's got some of the better ones. So I think the big regional malls, big super malls are probably okay, but I think it's going to be hard. I think the whole question about rents for shopping has to come down in Australia, right?
Yeah.
They're just not the foot traffic.
And when you see someone like Solomon Lew with so much clout, having so many stores, basically dictating to the landlords that he wasn't going to pay rents over this period of the lockdown, there's a fight going on there. The analyst, Paul, thinks about 6.6% downside, so they're not excited by it. That's not a bad rating. It could go either way with a number like that. But I think there are better stocks out there at this point in time.
Yeah, I mean, the share purchase plan will be, I just can't recall the price offhand, as I'm not a Vicinity shareholder, but it'll be lower than that. But look, it's probably, would I be putting a lot of capital into retail shopping centres? My answer is no.
Okay. Stuart Payton, hey, gents. I'm trying to be a long-term investor, but keep taking profits off the table as the market recovers. We understand that there may be a correction. Paul mentioned this morning to keep some cash ready to roll on a step down. I feel a bit like a dick that I've had sold too early as I watch the market continue to increase. Any advice?
Well, there are two really good investment adages that are a bit contradictory. One is you never go wrong making a profit. The second one is
never go broke.
You never go broke taking a profit. The second one is let your profits run.
Yeah.
I have to say, of the two, I probably prefer let your profits run because markets just keep surprising us. So I don't know what else to say. That look, I can't understand why the market's at 6,000. I can't understand why Wall Street's where it is, but it is. And you just got to go with the flow sometimes. So I think what you can do is when you see a buying opportunities, you can actually, that's the time to sort of weed out your weaker performing or your less preferred stocks and actually exit something that you may like, but it's not really doing much. Or if you've got a choice between this stock could go up 5% or this new stock you think could go up 20%, well, get rid of the one that you only reckon is a 5% one if you want to take a bit more risk.
Yeah.
So,
and another attitude can be that you actually sell the stocks to cover your costs going in, and you're sitting on your profits. At least, and if it comes off, you can go again. But Stuart, there's no easy one. And I've got to say, I'm gambling that this market keeps going higher. But I must admit, I was waiting for maybe a 7 or 8% pullback. But I would have bought those same companies I bought 3 or 4 weeks ago. I'd buy them again, because I think that the first year of a comeback of the stock market in Australia after a crash is between 30 and 80%. Now, Paul, you annoyed me when you told me this week we've already come back 30%.
45, well, 35 in Australia and 45 in the US.
Yeah, so we may well have gone up far enough, but it's going to be in the hands of second.
I would have think we're now at 6,000. That it'll do some work around 6,000. I'd be, it doesn't mean we can't go to 6,200, but it's a big number. Remember, it took such a long time to get up here before to break through 6,000. So I suspect that just the chartists are going to say there's going to be some resistance somewhere around here, and this is probably really profit taking a region anyhow.
Yeah, but I think. The Dow crossed over its 200-day moving average, which is another reason.
All the charts are bullish in the US. So.
And the economic data coming through, even in Australia, is starting to. You never look at as you guys know, I'm not giving you the usual what I liked and what I didn't like, because the stuff you're going to see on the don't likes are going to be for months like April and May. They're all going to be bad. But if you look at the stuff that's now, like the consumer confidence number, weekly one from ANZ Roy Morgan, it's up nine weeks in a row, and that's a good sign. That's part of the reason why the stock market's responding so well. Next question, Paul G. Torrens asks, AFG, Australian Financial Group, got a view on it? Big mortgage broking group, aren't they?
Yeah, I mean, I'd be interested what the analysts say, Peter.
13% up.
Yeah, it's probably not a company I want to own. It's I don't have any real position in AFG.
Yeah, it's going to be a company that's going to do okay. I just don't see it shooting the lights out. The mortgage brokers have really wrestled a lot of market share off the banks, but that market share still goes back to the banks, doesn't it, Paul? They actually get the loans. They're about 55% of all loans.
I mean, if you look at the macro statistics, there's no credit growth, and you've got to still, the banks are still lending lots to businesses, and they can't through the government supported programs. So being a broker in this environment is going to remain pretty tough work, and I can't see that, particularly with expected some sort of impact on the mortgage market, the home market. I think it's going to remain the case, Peter. So
I don't think you'll lose money in AFG, but I just wouldn't expect you making a lot. I think there's better stocks out there to make some money out of. Michael Birmingham, question. I'm 36 and plan to invest 35K a year into the market and not touch it for 20 years. I'll predominantly invest in the index funds. If you're in my shoes, what timing strategy to buy would you use? Dollar cost averaging, value averaging, or try to time the market and go in on any dips, or some other type of strategy? Come on, Paul, and be right.
I think if you're going to invest for 35 years, I think it doesn't really matter. I think you just invest. Sure, you can try to find the dips, but sometimes they don't always happen.
Yeah.
And I'm not sure, the trouble with things like dollar cost averaging, you put, say, the first 10,000 in and you wait and hope for it to come down again, and it doesn't. So, I mean, I think effectively what you could do is just invest, an X dollars per quarter or something, or X dollars per month.
I think that works out better.
Yeah, and that might be the easiest and simplest, and not try to overthink it too much.
Yeah, because you know why? What happens is, you put your quarterly amount in, and sometimes you're riding the uptrend, but sometimes you're going to get a very big bet when the market's gone off the boil, when most people are scared. But because you're buying good quality companies, you're getting it at a really good price. So I tend to agree with you on that one, Paul. I'd throw in another little point that if you're going to be, you're 36 for 20 years, that's 56. I would be thinking about doing it inside a self-managed super fund, because when it comes to you realizing your stocks, you're going to have a lot of capital gain inside a super fund. The tax regime's a lot better. That's not advice. That's just, I guess, a little observation. I know I didn't start using a self-managed super fund for my investments until I was probably in my early 50s. And I really wish I'd started in my 40s, because a lot of stuff that would have had capital gains, well, I must know, I held it anyway. But still, I think the important point is think about what vehicle you want to use for investing like that. John, the question from John. Love this segment. Thanks, John. Would love to hear your thoughts on STAR, SGR.
Another stock. I think I'm a small shareholder in STAR. Cannot get excited by STAR.
I had a bit of a win this week, didn't I, over Barangaroo?
Yeah, I mean, I sort of, I hadn't noticed it actually had gone up that much just looking at the chart. So thanks for bringing that up. I don't know. I think I put STAR and Tabcorp and in some ways Crown in the same boat a little bit. And I just can't get, I mean, look, maybe they're making headroads against their competitor Crown.
Yeah,
I don't know.
Yeah, Barangaroo is not going to get poker machines, I think, to 2040 or something like that.
Yeah.
So that was a good thing for STAR this week. It's had a nice comeback, but it's still a long way from where it was before it. But
I don't think, I forget if I was looking for stock. I don't think this one I'd pick. I mean, I'd be surprised there's much upside from the analysts in it. It just doesn't seem to want to do enough for me. And I don't know whether any of these companies, Tabcorp, STAR, are that well run. I think that there's question marks a little bit about how
it pays a reasonable dividend, Paul. You're a dividend man.
I'll bring up what the forecast dividend yield is while you're talking, Peter.
Okay.
But I have to check that one.
Yeah, I've never held STAR, but I just have the feeling that it's not a bad dividend.
It's one of those stocks I've held for a long time and done absolutely nothing, right? And it's sort of just one of those stocks that, why did you ever hold it? It's sort of, yeah, I don't have much in it, but it's just one of those annoying, I'd describe it as an annoying stock.
Okay. Okay.
I'll give you, according to the analyst, the forecast, just to bring up the yield here, is 3.3% this year. That's 20, and next year they're forecasting 0.3%. So,
0.3%.
well, that's because there's going to be no final dividend or almost nothing next year.
Okay. So therefore, that little appeals.
I'm not sure whether they've got a target of 326. It's currently at 323. So I don't see much. And probably, maybe if you've been a long holder of this stock, this is the time you get out.
Yeah. Peter Amelides, what will be the repercussions once the government stops their stimulus programs, JobKeeper in particular? I think they'll phase it out. They won't just chop it in September. They've obviously saved money because only 3 million are on JobKeeper. They thought 6 million. I think the government will just start picking the industries that don't need help, and that they will lose JobKeeper. But if you're in tourism or hospitality, all those sorts of industries, they'll get.
Well, there are three ways they could do it. To qualify for JobKeeper, your turnover in April or March had to be down by 30%.
Yeah.
Look, there'll be a lot of industries come September who won't be able to establish that for September. So the first thing they'll do is say, okay, you've now got to prove that your September turnover was also impacted.
Yeah.
And that'll cut out a lot of people up front because there'll be some recovery. Then I think, Peter, your second option they'll have is then make it industry specific. That might be harder.
Yeah.
And the third is that they'll say, well, we'll keep it for another 3 months at this level, and then after that they'll reduce the level each time. So there'll be some sort of transitionary process out which will see it paying less money to fewer people.
Yeah, and I think that's the bottom line, is that they actually had a bit of a windfall when they realised they didn't have spent so much on JobKeeper. So they're going to use it as a bit of a war chest. They know that they have to get the unemployment number down as quickly as they can, and history has shown that economies can rebound after a crash, but the unemployment numbers can be really sticky because some people are saying, during that downturn, we realised there are a few people here who are either overpaid or unnecessary. and those people often find it very hard to get a job. So I think the government will be spending judiciously in the sectors that are affected. Also, Peter threw in a question on GrainCorp, Paul. Analysts don't see it doing anything exciting. I find agriculture stocks hard to play.
I find agricultural stocks incredibly hard to play and incredibly disappointing.
Yeah.
I'm a farmer, that's as well. But GrainCorp, you look at that, you say, why would you ever bother investing?
And the drought's kind of over, and we're not seeing a big bounce.
I don't know, too hard, I think. I think I just, if you got the
He's a
analyst
farmer as well.
you've got to know, you've got to go to your market and you've got to take a view. It's just too many risks. I think there's better elsewhere.
Okay, here's an easy one for us. John Daly's got a question on MQG. Its previous high was 146. If so, what do you expect it to have? So will it reach the 146 number again? My bet is yes. Betting against Macquarie has not been a very sensible strategy. I do believe that 2021 is going to be a rebound year right across the world because of the stimulus that's been thrown at it. As long as there's no second wave infections, Macquarie will head up towards that number. My best guess would be. But if there was a bit of an outbreak and a second wave, but it's not as serious as the first, the market comes off the boil. If Macquarie went under 100, I'd be happy to buy under 100.
Yeah, well, one of the really interesting things about Macquarie is it has, over the 40 odd years, because it started, it's been able to reinvent itself.
Yeah.
And Macquarie was originally a cash management trust. That's where it started.
Samuel Hill, wasn't it?
Hill Samuel.
Hill Samuel.
Then it realised that it needed to do more than that, and it got into trading, became a huge equities trader. Then it decided it didn't want to be that was high risk, so then it became a huge funds manager and went into infrastructure and owned Sydney Airport and all the toll roads. And then it reinvented itself again about after the GFC. It's done a...
It's entrepreneurial,
It's
really.
entrepreneurial, and we over the next 3 or 4 years, there's going to be a lot of change in markets and funds and all sorts of things in finance. But Macquarie has shown it is capable of effectively not reinventing is probably, maybe that's the wrong word, but really changing what it does to change for the circumstances. And I think that's just one of the companies you back.
Yeah, it's got a dynamic investment strategy, hasn't it? And look, go away.
Dynamic business model. It will change, and if it's going to find things tough, it will move into newer fields. I'm confident of that.
The analysts think it's got 1% downside. The target was 116. They pretty well made it yesterday. I think the bottom line is all the analysts probably believe we're going to go sideways for a while, and they could be wrong. If we're going up, Macquarie's going to be taking us up, that's for sure. But there could be a buying opportunity if there's a bit of a sell-off, and I'd be very happy to pile into Macquarie around 100 on the basis that over a couple of years period, we probably see it back at 143. That'd be my best guess. Okay, I've got one more, no more questions. Okay, I guess we should finish up on that, Paul. People are asking us, well, there is one question here from John on REH.
Where are all these hands today? We're not...
Yeah. REH, Paul.
And RIA?
Yeah. REH, not Rio.
REH.
Yeah, it's not one of mine. I'm going to check it out.
As in, Reese. Okay.
Yeah, Reese, yeah.
Okay, the plumber. Yeah, look, they've had a pretty good bounce. Look, I think they're not a bad company. Whether I'd be piling in now, if you look at that, Peter.
Yeah. Well, I think last time we were talking...
Got a question on Reese.
Yeah, we made the point that Reese was exposed to the construction sector. It probably had been helped by all this talk about renovations. They do a lot of stuff in the renovation space. And it's a good company. There's no doubt it's a good company. And probably because of what the government's trying to do, its outlook's not going to be jeopardised whatsoever. And finally, GWA. What's your view on GWA, Paul?
Again, that's a tricky company. I probably a company I never touched, GWA, and I couldn't tell you why. I'm actually just looking at that chart. I'm a bit surprised it has bounced the way it has, Peter. That's it's sort of.
Analysts think 11% up.
I'm going to go with the analysts. Let's stick with what the analysts say. So just if I can bring that up for one sec. The analysts have a target price on GWA of 368, which is 11.5%. They're pretty neutral on the stock. Each of the 4 brokers is neutral. That's encouraging. So, you know, dividend yield looks all right. Quite attractive. PE's not over the top. So, but I find that GWA is a tough company to get a real handle on. So, I guess you know, if you want to take anything, look at the analysts. But on a technical basis, you'd have to say that chart looks pretty good.
Yeah. Well, guys, we are out of time. Thanks for joining us. We look forward to talking to you next week. It's a new habit for us, Paul, getting together on a Thursday at 12 o'clock, but we certainly enjoy it. I hope you enjoy it, and we'll see you next week.